Welcome to Tesla Daily News podcast on January 23rd, 2026. Today we're tracking a mix of supply chain wins, demand signals in Europe, and new headlines around autonomy, insurance, and cybersecurity that could shape Tesla's margins, growth story, and investor sentiment. Let's get into the 5 biggest Tesla developments moving the conversation around the stock. Story 1. Tesla says its Texas lithium refinery is now operating, and that's a big deal for battery cost and supply risk. Tesla has shown new images and messaging around the ramp of its lithium refining facility in Texas, with Elon Musk calling it the largest lithium refinery in America. Here's the context investors care about. Lithium is still a key input cost for batteries, and battery costs are still the foundation under EV gross margin and Tesla energy storage economics. When raw materials spike or supply gets constrained, margins compress, and Tesla has less flexibility to price aggressively. The detail that matters is that the refinery is designed to process hard rock lithium material, not just brines. Strategically, that's about shortening supply chains, reducing dependency on third parties, and creating a more predictable cost curve. Impact-wise, this is not an overnight earnings catalyst, but it's a medium-term fundamental positive, more control over a critical input, potential cost stabilization, and a clearer path to scaling both vehicles and Megapack without being whipsawed by commodity cycles. Takeaway: watch for 2 things in upcoming quarters: any commentary on refining throughput ramp, and whether Tesla starts to quantify battery material cost improvements. If they do, that's the kind of input that can move margin models and valuation assumptions. Story 2. European demand signals are flashing, with more discounting on Model Y. A French auto outlet is reporting aggressive pricing on the Tesla Model Y in France, with offers bringing the entry point to under €35,000. The context here is simple. Tesla has been fighting a demand and pricing environment in Europe that's gotten more competitive, especially as legacy automakers and Chinese brands push incentives. The key detail is that this looks like tactical discounting rather than a new base MSRP globally. For investors, the question is not whether Tesla can sell cars with discounts, it's what that implies for automotive gross margin and whether volume can offset price. The impact on the stock narrative is mixed. On the bullish side, discounting can defend market share and keep factory utilization higher, which matters for fixed cost absorption. On the bearish side, more incentives can pressure per unit profitability and reinforce the idea that EV competition is intensifying. Takeaway: if discounts broaden across major European markets, analysts will likely trim margin expectations unless Tesla signals major cost-down progress. If discounts stay localized and time-bound, the financial hit is smaller, and it may simply be inventory management. Story 3. Berlin headcount is down, but Tesla says it's normal churn. Investors should read this as a utilization signal. Multiple German outlets report that Tesla's Grünheide factory has fewer employees than 2 years ago. One report cites a current figure around 10,700 people, and another notes roughly 1,700 fewer workers versus prior levels. Tesla's public line is that it's normal fluctuation and not a significant job cut program. The context is Tesla's European production footprint. Grünheide is the company's core EU manufacturing asset, and Europe has been one of the more challenging demand regions recently. The detail that matters is the direction, not the PR framing. A lower headcount can come from efficiency gains, more automation, less reliance on temp labor, or simply a need to reduce costs due to softer output requirements. From a stock perspective, this can be read 2 ways. Optimistic interpretation: productivity is improving and Tesla is tightening operations. Cautious interpretation: Tesla is managing costs because demand in the region is not absorbing the same run rate. Takeaway: watch for any hard data on Berlin production cadence and delivery mix into Europe. Headcount changes are a clue, but the real stock mover is whether utilization improves or stays under pressure. Story 4. A major insurance signal: Lemonade offers about 50% per mile rate cuts when Tesla FSD is driving. U.S. insurer Lemonade says it will cut per-mile insurance rates by about half for Tesla drivers when full self-driving is engaged, starting in Arizona, using vehicle telemetry to differentiate between human-driven and FSD-driven miles. The context: if insurers start pricing risk based on real-world autonomy data, it becomes an independent validation channel for safety performance. That matters for Tesla because autonomy is tied to software revenue, take rate, and the long-term robotaxi valuation narrative. The detail to highlight is the structure. This is not a blanket discount for owning a Tesla. It's conditional on FSD being active. That is a direct economic incentive for customers to use the feature more often. Impact: near term, this could help FSD adoption and engagement at the margin, which supports Tesla's recurring software story. Longer term, if more insurers replicate this model, it could lower total cost of ownership for Tesla owners, boosting demand, and it could also strengthen the argument that autonomy reduces accident frequency. Takeaway: investors should watch whether Tesla references insurance partnerships and FSD-linked safety metrics in future updates. If third parties keep putting price signals behind FSD safety, that can shift sentiment faster than internal Tesla claims. Story 5. Tesla security headlines. Researchers quickly hacked Tesla's infotainment system at PWN2OWN. At the PWN2OWN Automotive Security Conference, researchers reportedly compromised Tesla's infotainment system and earned $35,000 for the demonstration. The context: modern vehicles are rolling computers, and Tesla is more software-defined than most automakers. That's a competitive advantage, but it also expands the attack surface. The critical detail is that this is an infotainment exploit showcased in a controlled security contest. That's not the same thing as a widespread real-world hack, and these events are partly designed to responsibly surface vulnerabilities so they can be patched. Market impact is usually about perception and regulatory risk. Tesla has historically been strong at pushing over-the-air fixes. If Tesla responds quickly, the damage is minimal. If exploits pile up or touch safety-critical systems, then you get bigger risk, potential recalls, reputational harm, and more scrutiny. Takeaway: this is a reminder that cybersecurity is now part of the auto margin and brand equation. Watch for Tesla's patch cadence and whether any issues spill into safety or privacy concerns. Story 6. The autonomy narrative stays contested. Public debate around cameras only versus LiDAR continues. This week included renewed criticism from a prominent self-driving voice aimed at Tesla's camera-centric approach, while other reporting highlights ongoing legal and safety debates across the autonomy sector. The context: the market still does not agree on the right sensor stack for high-level autonomy. Tesla is betting on vision and neural nets at scale, which could be cost-advantaged if it works, but is controversial. The investor-relevant detail is that this kind of debate can influence regulatory posture and consumer trust, which in turn affects FSD take rate, subscription growth, and any timeline expectations for unsupervised driving. Impact: sentiment around autonomy can swing Tesla disproportionately, because autonomy is not fully priced like a normal auto business. Headlines that raise doubt can compress the multiple. Credible progress can expand it. Takeaway: ignore the hot takes and watch measurable signals, software release notes, safety statistics, regulatory approvals, and whether Tesla can sustain higher FSD adoption without rising incident rates. Now, quick recap. Today's themes are vertical integration and cost control with the Texas lithium refinery, demand management in Europe with Model Y discounting, operating discipline signals out of Berlin, early third-party validation signals for FSD via insurance pricing, and a reminder that cybersecurity and autonomy narratives can still move sentiment. For tomorrow, keep an eye on two things: whether Europe pricing actions expand to other markets, and whether Tesla or insurers provide more hard data tying driver assistance to lower claim rates. If you found this useful, subscribe to Tesla Daily News Podcast and follow for your daily, investor-focused Tesla update.